What's going on, everybody? Eric Sandstrom, the Guideline Guru, here with Prime Lending. Today we're going to be talking about a popular topic, and that's debt to income ratio, or DTI. And specifically in this video we're going to be chatting about FHA loans as well. So first and foremost, we're going to be talking about what is debt to income, or DTI. What does it mean? Is it unique for every program type that's out there? So whether it's conventional FHA, USDA, is it all the same, or are there different debt to income ratio limits? We're going to talk about the difference between the front end and the back end debt ratio, and the FHA debt to income ratio for above 620 and below 620, all the way down to 580, and if there's differences between the two. All right, so let's talk about first, what is debt to income, or DTI? So what it is it's basically your new house payment plus your liabilities. So if you have credit card debt, car payments, student loans, things like that, that's going to be factored into your debt to income ratio. So basically you want to take into consideration the minimum monthly payments that you're required to pay, not necessarily what you do pay. And other things like utilities and things like that are not included in debt ratio. As far as the house payment, what is included is the principal and interest, the taxes, as well as the insurance. Okay. So that's debt to income. It's basically your debt divided by your income, and that will tell you what the ratio is. Okay. Next is going to be, let's actually jump to the difference between the front end and the back end debt ratio. What does that mean? What is the front end, and then what is the back end? The front end is the house payment. So that's what you pay on the house. Again, the principal and interest, the taxes, and the insurance. Okay, that's going to be the front end versus the income. Okay, so let's say if the mortgage payment is $3,500. That debt rate versus a $10,000 income, that debt ratio or front end ratio is going to be 35%. Okay, so let's say the same borrower that has $10,000 in income, and we want to determine the back end. Let's say the borrower has a car payment, or let's say 2 car payments, some student loans, and then some credit card debt that equal about, let's say in this case, $1,500 in debt monthly. So we've got $3,500 for the mortgage, which was $35,000 front end, and then the back end plus $1,500 for the $3,000. That's $5,000. So $5,000 versus $10,000 is going to be 50%. So that borrower is going to be at a 50% back end debt ratio. Okay, so back end is house payment, all the debt, and then divided by the income. Okay, so that's the back end debt ratio. All right, so next, is it unique for every program type? So there's a lot of programs out there. There's FHA, conventional, USDA, VA, a lot of different programs, right? VA really doesn't have a debt ratio. It's more based off of residual income. FHA does have a max debt ratio, and that's 55%, and that's what we're going to be talking about today. So the 55% is actually both the front end and the back end. They don't necessarily have a front end requirement. However, the automated underwriting system will have a mind of its own sometimes and not allow you to go above a certain amount on the front end. Automated underwriting is basically Fannie Mae, Freddie Mac system that determines your eligibility, okay? So you may not get an approval if you've got $1,000 income per month and the mortgage payment is $500 or $550, okay? It may not work because it's just not going to leave you enough for food and things like that. So front end and back end. FHA debt to income ratio maximum, we already talked about the 55% rule there on the 620 credit score or above. The program does extend to all the way down to 500 credit. We do not offer that here. We offer a 580 to 619 as well, as below or above the 620. The 580 to 619 is capped at a debt ratio of 31% on the front end and 45% on the back. Okay, so 31% on the front, let's say again $10,000 income borrower, that's going to max them out at about a $3,100 mortgage payment, which could get you probably somewhere around $520,000, I would say would be a rough estimate. And the back end debt ratio is 45%. So they can have a little bit more liabilities in regards to the house, but the house payment cannot be more than 31% of the borrower's income. Okay, so that's the gist about FHA and how debt to income ratio works. Check out my other videos and please make sure to sign up.